Hello and welcome to Financial Allocations for Freelancers. This is going to be a short, sweet little video on how to split up your finances and why. And I'm going to talk you through it using a tool that I have built. So if you want the tool at the end, raise your hand, let me know that you want it. Along the way, I'm going to write some notes. Yeah. So I'm going to do this for a start because before we get to the sharing of the tool, because it's really important to understand why you would allocate finance out. What do I mean by allocations? A finance allocation, an allocation is something that is a split, right? So you split your revenue into percentages to achieve particular goals, to achieve particular goals. And this is particularly helpful because most freelancers don't separate their wages, separate their spendings, I should say, from their business. They take everything from their operational account, they don't track it poorly, and they freak out about not having enough money, right? The worst thing about this is that then come tax time, what happens? You look at your ops and you go, shit, I don't have enough money to pay the tax man. Oh no money. And that's not the way you want to live. When you have all your money piled into a singular account, or even say two accounts, you don't have a real appreciation for where your money is going and what job it is doing. You want to give your money jobs to do. This comes from an amazing coach, an amazing finance coach, whose name is Miriam Castilla. And I am not going to teach what Miriam Castilla teaches because she does it in a very particular way and it's very, very good. But Miriam is in the same league as people like Mike Michalowicz, who is the author of First, which if you haven't read, you totally need to read. So I'm going to include that in the notes here. Now, the kinds of allocations that you need to know about, the first one is that you need to have your tax set aside. That's a not negotiable. Every time you earn money, a portion of that doesn't belong to you, it belongs to the tax man. And a lot of people say, oh, I hate paying tax. You should be grateful that you have to pay your tax because it allows you to contribute to your society. That's the best way to look at it. Hey, isn't this awesome? I'm earning enough money that I get to pay tax this time. And the best thing about this allocation is if you do it from day one, you never ever have a tax bill. So you set your tax aside. And how much do you set aside? Ask your accountant. My guiding principle is it should never be more than 30%. And in fact, if it is 30%, then you want to be finding out what you can do to reduce your tax. Never more than 30%. If it's 30% or higher, boy, you've got some work to do. Set your tax aside. This means 30 cents out of every dollar goes to the tax man from day one. The second thing you want to set aside is your profit. This is a principle that comes from Mike Michalowicz. Profit in Mike's world is play money, reward money, quote unquote dividends. But the profit actually is the lifeblood of your business. So if you're paying out a bunch of things and you don't set your profit aside, you won't have any more money to put back into the business. Money to a business is like blood. And that's why if you're spending too much, we call it bleeding, right? Set aside your profit. It should be between 1% to 10%. You decide. If you set aside 10%, amazing, do it from day one. If you do it from day one, you'll never miss it. If this is new to you, it's going to feel odd because you're going to have to adjust a bunch of things, which I'll get to. So you've got your tax set aside. Great, don't have to pay the tax man. Got your profit set aside. Brilliant, don't have to worry about that. What else is there? Like, do you take holidays? Do you get sick? Do you have parental goals or actuals? Do you need carers leave? Do you need maternity leave? What are your big goals? There's an operations cost as well, and typically operations includes your wages, and your operations should never exceed 30% in a healthy business. Now, because cash is blood to your entity, your business, anything that you're overspending is bleeding. Many freelancers don't have effective budgets, so they don't know where where is that line. This is one way around this budget idea if you have an aversion to doing budgets. If you're like me, budgets ended up becoming illusory because you just make them up, right? But when you do this, you have a known knowns, and there are ways to do it which we'll get into in a minute. So if you have 30% going to the taxman, you have 30% in your operations, there's 60% of your cash gone already. The remaining 40% is where you get to put into the business. You can reinvest it. You can put it into holidays. You can put it into long-term goals. You can pour it into something else, marketing, whatever, leave it in the business. Those two things are the key things. If you don't set aside your profit though, what you'll do is you'll end up just taking all of your expenses away from your revenue, and then you'll say, oh, there's nothing left. There is always something left. You can always afford to put aside 1 cent out of every 100 or 10 cents out of every 100. And that is where your profit comes from at the end of the quarter or at the end of the year. You can pay it quarterly, annually, half yearly, up to you. Typically it's dividends, so it's play money, but I like to see this as investment money, right? You can use it to reinvest, put it into advertising, put it into marketing, put it into something else, particularly if you've already got your holidays paid, right? Which is what we're going to get into. So that's where it comes from. The other thing that is missing from this list, right, is your retirement savings, whatever that is. If it's super, if you're investing in shares, if you've got investments in crypto or real estate, or you've got a self-managed super fund, which I doubt they're so expensive. Or if you're in the US, you've got a 401k, whatever it is. Okay, you've also have to have retirement savings. Otherwise, you're going to want to retire, and you will have nothing. Don't be one of those people. Remember that one day you might want to stop working. So this is what we have. Now, the problem is many of these things, for example, these kinds of goals and holidays and sick pay and long service leave, and I didn't even put that in. What if you want to have a long sabbatical or something? How much do you set aside, and how often, and for how long, and how do you do it? So this is where we're going to have, and I'm going to share with you something that I have built. And what I have built is this spreadsheet, which is a finance allocation system. This is what it looks like. It has a big README at the front that tells you how to use it. One of the critical things to remember is that this isn't a hard and fast rule. This is a model, okay? And the thing is that I'm going to teach you is how to use it as a model, which means to model your financial situation, and from the model build rules. But the rules are still not hard and fast. When your situation changes, you can still remodel what you've got. And that's what you want to remember. Use it as a model. This includes things like, what do you do about your debts? How do you do bigger goals? How much is your allocation? But there's also one really critical thing in the introduction, which I haven't covered, and it's that using business funds for personal activities is stealing. Okay? Stealing is a real thing. I'm going to add this to the notes as well. Stealing is a real thing. And what I want you to understand is that when you have any kind of expenditure, when you take it out of your freelance business, call it personal drawings or, owner wages or something. But the truth is, you're stealing from this entity that exists alongside you, known as your business. That becomes a real problem once you get into a company structure. If you decide to go that way, let's say you grow your business, it gets bigger. You have to have a corporate structure because of the contracts that you are getting or want to get. When you start taking money out of that entity for your own use, it's definitely stealing, or it's a loan, right? At some point, you're going to have to pay the loan back. And when you start doing this on the regular, if you end up taking money out of the business, when the business can't pay its debts anymore and you're trading insolvent, that becomes a very big problem, because this huge loan that you've created suddenly counts against you. And so what you want to do is you want to have good habits set up from the beginning. Many freelancers don't pay themselves a wage. And when you're very small, it's not possible to set yourself a wage. You can, in fact, I believe you might have to check with your accountant. You might have to do that when you're a corporate. But when you're small, you don't have to. Doing it on a percentage basis takes care of the problem. So let me show you what this actually looks like. First thing is you set up your leave percentages. In this book here, we've got a bunch of fields. The white fields are open fields that you can populate. I've pre-populated some of these already. So let's say you want to have like long service leave for 10 years. This maternity leave accrued for 1,000 years. That's awesome. Let's say you want to have your long service leave for 10 years. It calculates how many hours you've worked over that period of time, how much time off you want, 13 weeks. This is all based on the fact of working 50 weeks a year at 6 hours a day, roughly in a 30 or 38. Let's say we have a 38-hour week, something like that. Right? Something average to work it out. It tells you what your percentage rates are. So your annual leave is 6.32%, your sick leave is 3%, your carer's leave if you want it, your long service leave is 2.6%, etc. When you do this, you can then come into the model. The model allows you to put in your total revenue here. You can see I have total revenue here. Or if you have known knowns, like if you have total revenue, that's a known known, put in the total revenue. If you don't, but you have average spend from a bunch of known clients, you can put your clients in here and put in what percentage of the earnings that amounts to. You can change this to projects if you like, if you're a project-based freelancer. In any case, if you don't have any idea of the rolling nature of your revenue, this is going to help you get an idea about what that looks like. So plug in whatever you can here. The second thing to understand is your operational cost. These categories I've pulled out of my own accounting software because they're pretty well average. They run across just about every accounting platform you can imagine. You will have different ones perhaps, but these are your average. So you've got accounting fees, bank fees, books and publications that you buy, vehicle expenses, which includes fuel and transport and servicing and registration and, all those things. Client meals, computer hardware, contractors and subbies, blah, 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 blah. you will notice, if you're astute, that contractors and subbies is separate from wages. If you have a wage cost because you have employees, you will have employee wages under wages. Now, these are all simple. You may have some other ones. For example, you may apportion a section of your rent in your house. If you have a dedicated office space in your house, you may have the ability to do that because it's dedicated space that you use in a particular way. If you haven't, then you may pay for co-working space or whatever it is. Now, plug in all of the costs. If you have known knowns, plug them all in and it will calculate it for you. The reason that this one is here is because it allows you, remember I said this is a model, to model the percentage wage take, because your total operational cost should be no more than 30% if your business is healthy. Okay, so let's say, look, this is 36, so let's take 20% out of here. Now we have a healthy business because only 20% is going into my pocket. 20% of the operational cost. Okay, so when you start going, oh, but you know, the total operational cost is whatever it is, 20% or 2%, it starts getting smaller. It will terrify you, and that's okay. I'll show you why. Once you do this, work this out, then we think about the leave percentages, all right? The leave percentages that you set up in number 1. Blah, 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 blah. They should all be here. I have included profit as super and investing and stuff here because it's easy. You may wish to add your own to calculate it. Most of the time it's fine. Actually, that one should be that, because then you can change it if you need to. And this will tell you that per invoice period, we have this much money here. So that sum is $220, right? If we have this taken from wages, you'll notice this value will change, okay? If we add it to our wages, this is what it looks like. You may wonder why that happens. Okay, so if you have a corporate, then the wage that someone gets as their take-home pay excludes all of these things, but you have to pay them anyway. So if you want to treat yourself as an employee, you add these to the wages and not take them out of the wages. So in a sense, if you take them out of your wages, it's a really small value because you've only got, like, you know, X amount of money to play with. If you want to add it to your wages, then you have a whole lot more on top of that. Anyway, and then you have your tax and your profit here. You know, I've got profit here. You can put it here. That's up to you. So that's how, play with this. What you're going to have to do is work out whether your operational cost and the total set aside are eating up your total revenue. Because if say this operational fee plus the total that you're setting aside comes to more than this value, then you have a problem. In this case, you can see down here that the total is $4,198. So I've got, you know, just shy of $800 left over, which goes into sits in the operational account, and that becomes blood flow. If you're eating up more than that, then you're in a negative state and you've got some bleed. So model your allocations, work out what's going to work for you, and then forecast your year if you can. So in this situation, you can put in your client names. You will have some fixed expenses here, which you can then just copy straight across. But your year, if you're like most freelancers, will vary. So you may have some banging months in, say, August to October and February to May, but say January, June and December might be flat and dead. So this allows you to forecast, what your year is going to look like, because you may decide that in the great months you're going to you're going to take more, reallocate your percentages to leave more in the business for those other months. You may decide to put more into, change the percentage for some months so that you're taking more or less, etc. You may want to take more wage in the fast months than in the slow ones, whatever you do. So that is how this works. Now, what do you do when you've just got all of this done? You track your distribution. The thing is, if you have this set up correctly, what you're going to have is a bunch of bank accounts. And those bank accounts are really going to look like the allocations, okay? Because you're going to have a tax account here. You are going to want to have a profit account for that. These you may want to have as a combined account. So you have all of your leave in one account, perhaps in a single account. You will have operations. This is your money in, money out account. And this could go into your combined account. Or you might just pay it out straight away. In that case, what you're going to end up with is 1, 2, 3, 4, minimum of 4 bank accounts. So you're going to set up your bank accounts, okay? So you want to set up your 4 plus bank accounts, name them appropriately, and then every time you get paid, apportion your percentages immediately. If you have a cool bank that lets you do it automatically, set it up every time money comes in, gone. Then what you're left with is the money that you have. One of the things you're going to do that is this includes your wage component. Okay, so this goes to your personal account. Then from your personal account, that's where you pay rent, bills, food, clothing, health, etc. All your personal expenses come out of your personal account. This then enables you to have all of your cash accruing in the right place at the right time. And what you're going to also see is that then this component, tracking your distribution, becomes really important, because if you have a combined account for your leave, all your types of leave, then you're going to want to know how much you've accrued at the point at which you take it out of that account. Otherwise, that account is going to grow, and then you'll say, brilliant, going on holidays, I'm going to take all of that, and you'll take it all out. And then you'll have no sick leave, no long service leave, or whatever the case is, long-term goal you've got. Maybe you've got house renovations or something. Whatever you want to do, put it in there. Maybe you've got like a 5 or 10 year plan for your house renovation. You could do that, for example. So make sure you track your distribution every single time that you get paid, and that is going to enable you to go back and double check it. So let's just go back to this for a sec. All right, I'm just going to recap what I've done, because that is a whole lot of information in a really short space of time. So the allocation is something that's a split. You're going to split your revenue into percentages, and we went through and talked about what that looks like. Most freelancers don't do this. They freak out about having enough money. They end up in anxiety land, and then every time a bill comes in, they panic. Then when comes tax time, which is a case in point, they go, oh, oops, no money, and they end up on payment plans. This equals debt and payment plans, and then you're just in a world of pain, and you do that backwards for years and years and years, and you don't have anything worth doing. tip from Miriam Castilla. Check her out if you want to. You Google her, you'll find her. And read Profit First. Give your money jobs to do. When your money has jobs to do, it grows. It's actually simple. Your money grows. If you have an amazing little dashboard in your net bank, on your phone app or whatever, if you get paid, say, by people throughout the month, those account balances go up and up and up. And all of a sudden you're on a savings jag, and you didn't even realize that was going to happen. So when you allocate it, you set aside your tax. If you don't know your actual percentage, default to 30%, you'll always have something left over. But ask your accountant, double check if you can. Decide on your profit, decide when you're going to pay it, decide what you're going to use it for. If you're going to use it as play money per the Profit First system, that's amazing. I've done that. If you're going to use it for investment money, decide where you're going to invest it. Are you going to reinvest in the business? Good idea. Are you going to invest it in your future? Also a good idea. Just decide how you're going to use it. One of those three things, play money, reinvest in the business, invest for your future, they're all investing. One invests in you immediately. The other two also invest in you, but in different ways. Decide on your holiday, sick pay, other pay goal percentages. Use the model to do that and use your retirement. Overspending is bleeding. This is going to stop you doing that overspending because you're going to want to know your percentages. It's the fastest way to do a budget, best way to do a budget in the world. And remember that taking personal funds out of your business is stealing. When you frame it to yourself that you're stealing from this other entity, you're an entity, your business is an entity, are you going to steal from this person? No, you're not going to do that. It really challenges you to make sure that your spending is appropriate, that it is something you really do need, and maybe you could save for it out of your personal wages because actually now you have wages as part of your operational cost. So the other thing to remember is it's not a hard and fast rule, it's a model. Use it as a model, decide on the percentages, work it out, play with the spreadsheet, figure out what you're going to do. Once you've worked it out, forecast your year, set up your bank accounts, name them appropriately, and every time you get paid, apportion your percentages accordingly. Bam, bam, bam. Done. Now, if you want these notes, raise your hand, let me know. Send me an email, leticia@leticiamooney.com. I'll send you the notes straight away. And if you want the spreadsheet, same deal. We'll just give it to you. It's fine for you just to take it. It's not a problem, but let me know you want it. So there you go. Finance allocations for freelancers. Absurdly simple, terrifying the first time you do it, but run it for a couple of months and your whole life will change. I actually got a text message the other day from a friend of mine who I just told him about this system. He took some notes. He went away. He's a handyman. He sent me a text message saying, "This is a game changer. I have never before ever had to take money from anywhere else to pay my tax." He said he doesn't have a tax bill for the first time in his entire freelance sole operator business life, and it's changed the game for him. When I mentioned to him that he could do the same thing with holidays, he went, "Oh, you know what? That's amazing." So he had taken his operations cost to as minimal cost, and he was paying himself 45% because his costs were really low. But out of that 45%, he was then deciding on holidays and stuff. So you can see when you take these factors away from happenstance and you give them an actual place in the world, suddenly you, Joe and Jane Citizen, the freelancer, don't have to find the money for a holiday because you've got holiday pay. You don't have to take it out of your personal account because it comes out of your holiday account, right? Like that just makes sense to me. Hopefully it makes sense to you. I hope you can rock the system, and I hope it changes your life. Thanks.